What will you do when your money works for you? Welcome to the Tech Girl Financial Podcast with your hosts, Victor and Kim Gaxiola. In today's episode, Victor and Kim discuss the buzz surrounding recent IPOs in Silicon Valley and what investors and employees of these companies should consider when startups go public. From the home office in California, here is Victor and Kim.
Welcome back to the Tech Girl Financial Podcast. Kim, welcome back.
Thank you. It's good to be back, and it's good to see that the weather is changing and it is finally looking like summer.
It's actually feeling really hot. Really hot. And the one thing to clarify here is, at the beginning, when we start the introduction of the podcast, we say from the home office in California, but we should be more specific. We're actually in Northern California, in the heart of Silicon Valley, and talking about hot. This Silicon Valley is hot, right, Kim?
I feel the energy right now. It is really exciting.
That's awesome. So, there's been so much buzz in the news lately. As you know, many of the companies recently have gone IPO in March and April. Lyft, Pinterest, and just recently Zoom went public. A lot of excitement, a lot of enthusiasm. And there's also some expectations of some additional companies that are going to go public, including Uber, Expedia, and Airbnb. So all household names. And so there's a lot of buzz going on. Tell us what your thoughts are.
Well, this is one of the reasons I think we came back to the Bay Area, right? Yeah. A long time ago, back in 2008, 2009, was to be back in this environment. Every time if you're a visitor to Silicon Valley, let me back that up. I remember back in the days where we'd come back once to two times a year, and every time you drove on 101, you'd see new names coming up on all the office buildings.
Right.
And I always thought that was really cool because they were funky names, and you knew that it was tech, and it was all up and coming. And so that's one of the things I love living about the Bay Area is seeing what all these businesses are doing and how they're creating all these new jobs, new opportunities, new ways to be productive, and, even some new wealth.
Mm-hmm. Well, it's interesting. When you're in Southern California, when we went to school, we both went to UCLA and we're in Los Angeles, all the billboards, everything around were always entertainment industry related, whether it was the music industry or it was the movie industry. And even now, when we go down there and visit, all the billboards are, the upcoming premieres for your consideration when the Oscar season comes around. But here in the Silicon Valley, whether you fly into San Jose or San Francisco or even Oaktown, when you're driving around, all the billboards are all these tech companies. And so you get a real sense that this is where it's happening. And a lot of these companies, they're obscure names and then they become household names.
Right.
And that's really exciting.
Yeah. So that's really cool. I love that. I love entrepreneurialism. And you can see it's alive and well in this country. And, that's why when we look at a lot of people sometimes are wondering, why is the stock market going up? We have all this bad news going on today. But underneath it all, corporations are growing and small businesses are getting bigger.
Well, let's talk about that because a lot of these companies, obviously, that are going IPO are private companies that are looking to raise capital in order for them to have sustained growth, right? And oftentimes they're not profitable. So can you give us a little bit of insight as to, some of the reasons why companies go public and, what employees who are working at these companies should be thinking about?
Right. So let's just take it a step back because we say the word IPO and everybody hears it. It's a buzzword, but what does that really mean? So IPO stands for initial public offering. And that means, you remember when you worked at a private company and you were issued stock, but it really didn't mean anything because you had no way of seeing what it was valued for on the stock market. Today, we can look at companies, and if you want to know what Coca-Cola is selling for, you look it up and you find it. But if you're a private company that doesn't have public stock, you can only rely on what you hear from the company, and that's very limited information. So we don't know as much about the finances when companies are private. And they're usually a lot of small companies. However, some companies that are large, one in particular that I always like to talk about is M&M Mars, because everybody knows them and likes them, I think.
I love them very much. M&Ms.
They just never wanted to go public, and it was a family-owned business, and they didn't need the money They didn't need to raise money in the public markets, and so they kept it private. And there's a lot of advantages to doing that. Because now you don't have to answer to shareholders or file quarterly earnings reports, which make your stock go up and down based on headline news instead of taking a long-term approach. So, there's good and bad about companies going private or going public. And we have heard of some companies actually going private, like Dell, for example. They didn't like being public and they went back to being private.
Right.
So pros and cons you can see of both sides, but when you are growing and you need to raise a lot of money quickly because you'd like to hit the gas pedal on your growth, maybe acquire new businesses that are in your line, or to just, ramp up your production, what have you, then you may ask an investment bank. You look for an investment bank to work with, and they will help you go into the IPO market. And I'm really just giving you the basics here. There's a lot of work underneath that all, but I think it might put some of our listeners asleep.
Well, no, let's hope that's not the case, especially if you're driving the car, you don't want to fall asleep.
I know. So at any rate, if a company decides to go public and there's enough interest for them to do that based on what the investment bankers can analyze about their company and their finances, then they can bring it to the market. And at the time it is first listed on the stock market is when the company goes through IPO. Now, there's a price, that initial offering, which is not something you buy on the stock market. You can't go to E-Trade and just say, buy, XYZ companies XYZ company, because for that initial price, you have to get it through either an investment bank or one of their partners that are offering the shares, or through your company. Like in a lot of cases, people work for a company, and when they're private, they're offered the stock, and then it goes public and they have it then. So that initial public price is not the price that anybody is going to be able to get it at.
Yeah.
And then there's a price once that happens and it goes on to the public market, then you can buy it there. Now, when you buy it there, let's say the public offering, the initial price is $25. It could jump from that to $30, $50, or it could go down and nobody wants it for $10 or $15. What I love about the stock market is it is an auction.
It's an auction, right? It's a supply and demand, and people set the prices, right?
Yes. So, this means that either the stock is heavily in demand, everybody wants to buy it, in which case it goes up, or nobody really cares about it. Nobody's interested. And, nothing happens, in which case the price goes down. It is just an auction. So that makes it really interesting at first, because people are making their decisions of whether they want to own this company or not on very little information, because when it was private, nobody had access to their finances. So we're going on, a lot of speculation. My observation is, it seems that most of the companies that do go public are usually built around a very great idea, like an amazing idea. In some cases, they change industries. So, for example, Lyft and Uber, and it's interesting, they're both kind of going public in and around the same time, and they both do pretty much the same thing, but they did meet a defined need, which was getting people from point A to point B in an easy way using their app and then paying through the app and such. So I just find it interesting that that's the case, that you see companies that are going public that are very similar in their business models. Right. And that's really interesting too, because you look at Uber and Lyft, and Uber was in that market first. They're the ones that came up with the idea, and then Lyft came second. But Lyft is the one that's actually come first in their IPO. And, Uber's had a lot of bad press, and maybe that had something to do with it. We don't know. But the fact is, you never know. So you could be first to market, have a really good idea, and not end up being the winner.
Yeah, and Kim, you have much more background on this than I do, but my understanding is that in the last couple of years, there's been a lot of access to private capital. And so companies, even private companies, have been able to raise capital for their businesses without going to IPO. And yet my observation seems to be that these IPOs come in waves. So it looks like we're starting to get another wave of interest, more IPOs. It's kind of reminding me back of the .com days, right?
It is reminding me a little of that too, because there are times, again, that you'll hear a lot of IPOs out there, and then there are times where it's kind of quiet. And a lot of times you start hearing more about these coming out because the stock market is doing well right now. And that's usually a good time to go public. Because if you're going public, you don't want to go public when the market is falling.
Yeah.
Then what do you think is going to happen to your stock? It's probably going to fall too. So if the market is on the way up, then that typically is a friendlier environment. And so I think we are seeing that. The economy has been expanding for quite a while. And so things are good. But, on the flip side of that, I have this little bit of a pit in my stomach thinking, oh no, when we start seeing this many, does that mean we're hitting a peak?
Those are things that make you go,
Yeah.
are we?
So let me show you my crystal ball right here.
Oh, you got it. She literally has a crystal ball in front of her.
Oh my gosh. If we knew, right? We would be in on only the best ones and none of the dogs. And that's funny because if you are even eligible or have the opportunity to invest in IPOs through an investment bank and through a broker dealer, typically you have to buy a lot of them in order to get these deals. That means you have to take the dogs and the winners, and you never know which one is going to be the great one and which one's going to be the dogs. But, it's kind of like you have to kiss a lot of toads.
So one might be Facebook and the other one might be pets.com, right?
Yeah. So. And that's the truth. So, I always tell people ask me, how do I get in on this? Can I participate? And I said, it's very difficult and it's typically not successful. Because really the money typically is made from when you own it as a private company to that jump in price of the IPO offering. But I think there's a lot less money made from the IPO price to what an individual investor can actually go and buy it on, their brokerage account.
Right.
So I urge caution.
It's a good strategy, right?
Yeah. And I think when things go public at first, it's a bit of a gamble. Mm-hmm. It could go either way in the next few months. And long term, it may be a great opportunity. However, I think you have time to wait it out and see where the finances are going and how the company is going to operate once they're a public company and subject to a lot more regulation and eyes on them.
Yeah, and I think I think you apply the same criteria to just about any investment. You really want to look at the fundamentals and thinking, does this company have a good idea? Are they a market leader? Are they growing? Do they have, the legs to be able to sustain long-term growth leading to profitability? Okay, so now I want to get a little bit more granular because so far what we've been doing is talking about how the general investing public can get in or possibly get in on an IPO. Now, one of the things we love about Silicon Valley, and it's extremely competitive, right?
Right.
And you see all these names, Adobe, Apple, Google. I mean, they're all over the place, Facebook. Very competitive. And one of the things that these companies need is they're competing for talent as well. Mm-hmm. And so another way to be able to participate this way is if you happen to be an employee with a great talent, software developer, or an engineer that is in high demand, one of the things that's very attractive is you can join some of these organizations and then they offer you, the opportunity to participate should they go public. Right. So let's talk a little bit about some of the considerations when it comes to someone who might find themselves in a situation where they may have some convertible shares.
Right. Well, and even prior to that, I wonder, because you have worked for a private company in a startup world, and I think, how many employees are out there strategizing, what's the next private company I want to work for? And how many of these private stock shares do I want to be able to get? And that's why I think a lot of people sometimes jump positions or jobs from one company to another here in the Bay Area, because the more you collect of these at all of these individual companies, if you job hop, the more you may be able to increase your opportunity of having one go public.
In my experience and observation, Kim, I think that is definitely a strategy that a lot of people follow, just from the standpoint, because like you said, you just don't know which one's going to be the winner and which one's going to be the dog, right? And so you almost diversify your opportunities by choosing to work at different companies and being, and receiving, these either options or restricted stock units to be able to participate should the company go public. And I think a lot of people see this as an additional form of compensation. And one of the main differences, too, is that I think previously a lot of these were only offered to highly compensated key employees. And now there's a distribution of that wealth across all employees.
Right. That's really neat, because as you're saying, maybe it was the officers only that used to be able to get it. And now it typically is almost everyone as a sign-on. You get these shares. And so that already makes you a part of the company and a part of the process, which is exciting. There's a lot more inclusion these days. Another thing to look at is it's really interesting, because back in the 90s when this was happening and we were seeing a lot of IPOs, those companies that went public were a lot younger. Maybe they're like 4 to 5 years old, where now these companies that are going public wait a lot longer. And so, you may see a 10, 12, 13, 15-year-old company going public. And so it's kind of nice. In my opinion, that makes it, whereas maybe you were at a toddler age before of a business, now you're at a young adult age. And so that might be helpful to those companies and perhaps make it a better chance of doing well. And the other thing is that back in the 90s, a lot of compensation packages, because they were younger companies and they had less money to offer you as your salary, they would sometimes give you these, and at the time they were using a lot of stock options. They would use stock options to entice you. And so people would take these jobs that were low paying on the excitement and the opportunity of the stock options. That's changed now, because you're getting paid good money. Your compensation is market level in these startups. And in addition, you're getting restricted stock units.
Right. Well, I think it goes back to the competitive nature and seeking out that talent. And so now you're highly compensated because of the talent that you have. And I think that a lot of these offers for either restricted stock units is more of retention. Let me keep, because the vesting periods are sometimes 4, 5, 6 years. And so in order for you to maximize your opportunity to participate, you need to stick around for a while.
Right. And that is a tough call. So, we do a lot of benefits planning with our clients, and you have to, when you're thinking of changing jobs from one to another, you have to look at all the benefits that are included in that job. Because if you just go from one salary of, let's say, $100,000 to $125,000, is that really all you're netting is $25,000? Or what are all the other benefits? Do they offer a match? Do they have profit sharing? Do they? What kind of insurance do they have? And those are all really important questions you want to think about before signing up on the, and saying, yes, I want to work here. So it's a lot of what we talk about. And same thing goes with these benefits, these stock benefits. And so they all look a little different. and you want to weigh the pros and the cons and what you may be leaving on the table if you leave one company are not completely vested versus going to another company. What are you going to gain? And sometimes that's negotiable. So if you're going to lose something at one company, maybe sweeten the deal at the new company.
Yeah. Why not? Right?
Yeah.
All right. So let's paint a scenario here. Okay. You happen to be an engineer. You work for a company XYZ. They're producing an amazing widget, big software, big app. They go public. Okay. You hit the jackpot. Like they went public. And now you find yourself needing to manage what you like to call, and you've written about this before, your sudden money.
Yeah. Your sudden money. Okay.
What do you do?
Get a paper bag and start breathing into it. Slowly.
Deep breath.
Calm down, because typically you cannot sell that stock for a while.
Oh, this is where you do the sad trombone. This is when you do the sad trombone. Boom, 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 boom.
We should bring Noah in for that, our son. So there is usually a waiting period, and that's good, because if everybody that owned that stock on the inside had to sell it, what if there weren't enough buyers? That may definitely drop the price and create an imbalance of shares out there. So that's a lot of times why there is part of the reason why there is a holding period before you can sell the stock. So usually that's the first thing to consider. The second thing is, if this is compensation comes in a lot of different forms and shapes.
Wait, so you're saying I can't buy my McLaren?
Not yet.
So this is a form of compensation.
Yeah.
Okay.
Yeah, it is a form of compensation. And so we need to understand the rules behind it. And that's where, dig up those plan documents and all the paperwork you got with them that I love to review.
That's my paperwork.
Yeah, because that's where all the information is. So, that's something that we'll look at is what are the rules with this form of compensation with the stock? How long does it need to be held? And so on and so forth. So, and what can you do with that stock in the meantime once it goes from being private to public? So lots of cool things out there. There is, there's going to be that concern, because what if it goes public and it drops and you're saying, oh my gosh, this is so great. It's $50 a share and I own 50,000 of these. But then all of a sudden it drops down to $10 a share in the next few months. And you're like, oh, this isn't as exciting as it was the day it went public. And, so can you do something to protect yourself? And sometimes you can. And so those are some of the resources we look at using for helping our clients. Can we protect that position? And the second thing is, of course, I'm going to bring up the T word. Taxes.
No. Yeah. Oh, well.
So everybody doesn't like paying taxes. I don't know. There's not too many people that are okay about it. Freedom is not free. But at the same time, you have to look at this. So you have to look at this like anything. If people win the lottery, they have to pay taxes. Yeah. I keep telling you, if you win $1 million on the, what's that show called?
Deal or No Deal?
Deal or No Deal. Yeah. You're really only going to net about 500,000.
Hey, it's still $500,000. I'll take it.
It's
just for
not
picking
$1
a
million.
suitcase. Just for picking a suitcase.
Right. So, understand the tax situation and just get comfortable with it. There's things that may be able to help you out, and you can work it with the CPA, and they will strategize with you and with financial planners to make it do the best that it can do. But, from time to time, I ask people, I said, what's worse? Paying the taxes or seeing the value of that money drop in half or even more than that. Because we've seen in really good days, a company that I saw people that would have $5 million, $10 million, and then that turned into $1 million or $500,000. Nothing's guaranteed.
No.
And so would you prefer to just capture the gain that you have, pay the taxes, and move on?
Mm-hmm.
And the nice thing about once you pay the taxes and move on is now you can diversify.
Right.
Because owning one stock is always a big risk.
Sure. Yeah. Those concentrated stock positions are really risky.
Exactly.
Yeah. And I think a lot of this underscores the importance of why you would want to work with a crew. It's a financial squad like we do with tax professionals and people who know about corporate stock rules and regulations.
Right. We want to know, we want to be on the same conversation. You should have your financial planner there. You should have your CPA. And guess what? You may even need, you probably should have your attorney there too, because long term, you're going to want to protect yourself. You want to protect your family. And you want to make sure that this goes according to your wishes and not the government's.
So it sounds like what you're saying is that right now, if you are working at Zoom or Lyft or Pinterest, these are all things that are probably percolating in your mind right now that you should be thinking about.
They are. And I would say plan ahead. Most of these companies at least have a hold of 6 months, if not longer. Mm-hmm. So plan ahead. You have the time. And I would say what you really want to do, stop thinking about what you're going to do with the $1 million or whatever.
Right. So no McLaren.
Yeah. No. Just think about, hang on a second. If I didn't have to go into work every day, what would I want to do? What would my life look like?
Bike, travel, eat, drink fine wines. I mean, were you asking me, or you were just saying rhetorically?
Well, I know you're thinking that, but think about the things that you want to do when you have financial independence. And because if you start strategizing around how to build financial independence and the lifestyle that you want, instead of, I could buy a bigger house, I could buy a boat, I could buy all these things, then you're probably more likely to be more successful with your finances. There are a lot of people that, there's a statistic out there that says most NFL players go broke.
Yeah, I think 80% are retired NFL. Yeah.
Yeah. And how can they? They have $40 million contracts.
And in the first 3 years out of the league.
Yeah. And so, again, it's like easy come, easy go. You don't want it to go. So what you need to do is, instead of thinking, because big ticket items mean big ticket expenses. You buy a big boat, you have to park it. There's the gas. There's so many things. You buy a big house, you have to heat it up or cool it off. And, so much goes into that. Big ticket items have big expenses along with them. So now you not only have the fact that you buy these items, maybe you pay cash for them, your maintenance cost is going to be really high. And can you afford that on an ongoing basis? And do you want to put that kind of stress in your life? So I'm a party pooper, huh?
No, because I think the big question you're asking is, what will you do when your money works for you? And here you find yourself in a situation where you could have a windfall of sudden money, and what you don't want to do is find yourself, and I'm using this term here, into a sudden wealth syndrome. You don't want to find yourself in a situation where you've got this windfall and then you find yourself in a situation where you have this syndrome of wealth, and like the NFL players, you find yourself squandering it away.
Right. And you just may not be that happy after all that. But if you take a different approach, and I love that question, because it's like we work day in and day out to bring in that paycheck. But what if you flipped it around and said your money went into work every day to provide you a paycheck? What if your money worked for you? And that's what it does. When you have a financial planner and you invest your finances appropriately, it will work for you in a very productive manner. And so, that's where we want to go with the conversation is how do we build the lifestyle that makes you financially independent?
So I'm going to end where we started, which is we are here in the heart of Silicon Valley, where a lot of the buzz and conversations around IPOs and companies that are private that go public, and people might find themselves in a sudden windfall of opportunity because they can participate in the fact that now their stock is public and they can exercise those rights and have that windfall.
Right. And it can be very overwhelming because you may be thrown out a ton of terms that you don't understand and are complicated and, quite frankly, just put you to sleep. And so you really want to work with an expert that can help you, has fun reading those documents and knows how to explain it to you in an easy form that will allow you to be able to make empowering decisions that help you throughout your life.
Right. And so we'll let you know that Tech Girl Financial has a deep roster, both of financial professionals that are here to help with those conversations and the discussions. So we invite you, if you're interested in finding out more, to reach out to us on our website and contact us also through the website. For those of you who are on Twitter, if you have a question, you can also use hashtag AskTGF. But we are really excited to have shared this. I mean, we're excited about what's happening here in Silicon Valley.
Right.
And so we invite you to reach out to us, and we'd be more than happy to help. So my name again is Victor Gaxiola.
And I'm Kim.
And we are Tech Girl Financial. We want you to answer the question, as always, what will you do when your money works for you? Thank you.
Thank you.
If you have questions, comments, or suggestions for future shows, please send an email to victor@techgirlfinancial.com or join the conversation on Twitter using the hashtag AskTGF. We also encourage you to follow us on the Tech Girl Financial page on Facebook and connect with us on LinkedIn.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. Tech Girl Financial and Cambridge Investment Research, Inc. are not affiliated companies.